The bear case for NatWest Group is not a critique of the bank's management or its strategy, but rather a warning about the environment in which it operates. As a domestic-focused UK bank, NatWest is a leveraged play on the health of the British economy, which is currently facing a perfect storm of geopolitical and fiscal challenges. The Iran war and the inflationary black swan. The most immediate threat to the NatWest investment thesis is the escalation of conflict in the Middle East. As of March 2026, the Iran war has driven oil prices above $100 a barrel, a level that threatens to reignite the global energy crisis. For a bank, this creates a two-pronged risk. It stokes inflation, which delays interest rate cuts, and it acts as a tax on consumers and businesses, increasing the risk of defaults. The shift in market sentiment has been dramatic. In late 2025, markets were pricing in an 80% probability of a rate cut in March 2026. By early March, that probability had plummeted to near zero, with some analysts even suggesting that rates could rise to 4%. The bear case argues that higher for longer rates in a low-growth environment are toxic. Unlike the 2023-2024 period, where higher rates were manageable, the 2026 scenario involves an economy with no slack. Families are rolling off historically low fixed-rate mortgages onto rates that are now expected to remain elevated for the foreseeable future. This mortgage cliff is no longer a theoretical risk. It is a current reality that is depressing consumer confidence and household savings. Domestic concentration and the credit cycle. NatWest is almost entirely dependent on the UK market, with its brands, NatWest, Royal Bank of Scotland, Ulster Bank, Coutts, having deep roots in every nation and region of the country. While this provided a moat during the recovery, it now represents a significant concentration risk. The OBR's projection of unemployment peaking at 5.33% in 2026 is a critical red flag. The loan impairment rate, which was a benign 16 basis points in 2025, is almost certain to rise. For a bank with a £388 billion loan book, even a modest increase in defaults among small and medium-sized enterprises or over-leveraged mortgage holders could wipe out the gains from the structural hedge. The bear case notes that farm business confidence is at low levels and investment is being limited by sticky economic conditions and the withdrawal of direct payments, highlighting the stress in the commercial book.
Deposit beta and competitive flight. A major risk to NIM, often overlooked by those focusing solely on the structural hedge, is deposit beta, the sensitivity of deposit costs to interest rate changes. As of 2025, the UK banking landscape has been transformed by digital-only challengers. A 2025 Finder survey revealed that 40% of Brits now have a digital-only bank account, up from 24% in 2023. Current deposit dynamics emphasize the threat of flight. Digital-only account holders, 21.5 million people, 40% of Brits, creating a high threat of deposit flight to better rates. Main attractor for digital. Higher interest rates are the primary driver for 15% of users, meaning traditional banks must pay more to retain cash. Customer deposits, FY 2025, £441.7 billion. While a large base, it remains vulnerable to hot money. Deposit growth Q4 2025, £7.0 billion, providing evidence of active retention efforts. The bear case contends that to maintain its £441.7 billion deposit base, NatWest will be forced to offer increasingly competitive rates on savings, particularly as the mass affluent become more rate sensitive. If the cost of deposits rises faster than the income from the loan book and the structural hedge, NIM will compress regardless of the Bank of England's base rate. The rise of commercial variable recurring payments and open banking only makes it easier for customers to move funds instantly to the highest bidder.
Acquisition, execution, and governance overhang. The market's tepid reaction to the Evelyn Partners acquisition reflects a fear that NatWest has overpaid in a defensive move to shore up its ROE. Integrating a £2.7 billion business is fraught with execution risk, particularly regarding the retention of key financial advisors and the cultural alignment of a high-net-worth wealth manager with a retail banking giant. Furthermore, the shadow of Fred Goodwin and the controversial history of RBS still affect investor sentiment. The 33% increase in CEO Paul Thwaite's pay to £6.6 million has drawn scrutiny from some quarters, particularly as the UK economy struggles. While seemingly minor, these governance noise factors can prevent the stock from achieving a full valuation re-rating, keeping it stuck at a discount to its intrinsic book value. The bull case for NatWest Group is anchored in the transition of the bank from a legacy-laden, government-backed utility into a lean, technology-first financial powerhouse with industry-leading capital return capabilities. This thesis is supported by the bank's demonstrated ability to generate a return on tangible equity of 19.2% in 2025, significantly exceeding its own guidance and the cost of equity. Capital repatriation and total shareholder yield. NatWest has established a reputation as a premier vehicle for capital return within the FTSE 100, a position bolstered by its return to full private ownership in 2025. The bank's distribution strategy is not merely a byproduct of profitability, but a core strategic pillar designed to attract a specific cohort of income-seeking institutional investors. In 2025, the bank announced total distributions of £4.1 billion, a figure that includes both ordinary dividends and significant share buybacks. The bank's 2025 distribution strategy included several key components. Total dividend growth, 51.2% year-over-year, providing substantial real income growth for investors. Announced H1 2026 buyback, £750 million, to provide ongoing support for the share price and capital efficiency. Total distribution payout, £4.1 billion, demonstrating robust capital generation.
The implications of this capital velocity are profound. By reducing the shares in issue through consistent buybacks, illustrated by the daily repurchases from UBS in early March 2026, the bank effectively manufactures earnings per share growth even in periods of flat nominal profit. For a bull investor, this provides a valuation floor. As the share count declines, each remaining share represents a larger claim on the bank's substantial earnings power. The move to increase the ordinary dividend payout ratio to 50% by 2028 further solidifies the bank's identity as an income-generating asset, with forward-looking yield estimates for 2026 and 2027 reaching 5.86% and 6.45% respectively. Structural hedge reinvestment and NIM protection. A central element of the bull thesis that is often underestimated by the broader market is the mechanism of the structural hedge. While many investors fear that a decline in the Bank of England's base rate will inevitably lead to a collapse in net interest margin, NatWest's structural hedge acts as a powerful mitigant. The hedge, essentially a massive portfolio of fixed income instruments and swaps, allows the bank to lock in yields over a multi-year horizon. The analysis of the 2025 results reveals that NatWest expects structural hedge income to increase by approximately £1.5 billion in 2026 and a further £1 billion in 2027. This income growth is driven by the reinvestment of maturing, low-yielding hedges from the near-zero rate era into the current, significantly higher rate environment. Even if the Bank of England reduces the base rate to a terminal level of 3.0% or 3.25%, the yield on the structural hedge will continue to provide a revenue tailwind as older portions of the book roll off. The bull case argues that this £2.5 billion in cumulative hedge tailwind over the next 2 years provides a buffer that few European peers can match. It effectively decouples a large portion of the bank's gross income from the immediate volatility of the overnight index swap market, ensuring that profitability remains higher for longer, even if the central bank begins an easing cycle. Strategic diversification, the wealth management pivot. The acquisition of Evelyn Partners for £2.7 billion is the clearest indicator of CEO Paul Thwaite's ambition to shift the bank's revenue mix toward capital-light, fee-based income. By integrating Evelyn Partners, a leading wealth manager, with the iconic Coutts brand, NatWest is creating a dominant UK wealth powerhouse. This move is strategically relevant because wealth management income is generally more stable than interest income and carries a higher valuation multiple in the equity markets. The bull case views this acquisition not as an overpayment, but as a necessary transformation. With over 20 million customers, NatWest has an unparalleled top of the funnel for wealth services. The ability to cross-sell investment products to its mass affluent retail customers and its large base of commercial clients provides a low-cost acquisition channel that pure-play wealth managers lack. The growth in assets under management and administration to £58.5 billion, up 19.6% in 2025, suggests that the strategy is already gaining momentum, with 50,000 new customers investing with the bank for the first time in 2025. The AI-driven cost revolution. NatWest's investment in technology, totaling £1.2 billion in 2025 alone, is fundamentally altering its cost structure. The bank's commitment to becoming an AI-first institution is manifesting in tangible efficiency gains. The decommissioning of 200 legacy business applications and the migration of data to the cloud in partnership with AWS and Accenture are foundational steps that have already contributed to £600 million in gross cost savings. From a bull perspective, the convergence of high-margin wealth growth and a declining cost-to-income ratio targeted at less than 45% by 2028 creates a powerful operating jaws effect. The deployment of generative AI across 21 customer journeys via Cora Plus is just the beginning of a transformation that could eventually allow the bank to maintain its massive market share with a significantly smaller, more specialized workforce.
Comparative valuation, NatWest versus peers. To understand if NatWest is a buy or a value trap, it must be viewed within the context of the UK banking quintet: Barclays, Lloyds, NatWest, HSBC, Standard Chartered. The 2025 rally in UK banks was driven by a re-rating of the sector from a forward PE of 6x to 8.1x, but as of March 2026, a significant valuation gap remains between the domestic players and global giants like HSBC. Peer valuation estimates for March 2026 highlight the following standings: NatWest Group, PE ratio of 9.15x, PB ratio of 1.05x, dividend yield of 5.4 to 5.5%, and a beta of 0.79. Lloyds Banking Group, PE ratio of 14.76x, PB ratio of 1.07x, dividend yield of 4.4%, and a beta of 1.08. It is a pure UK play with high mortgage exposure. Barclays, PE ratio of 9.88x, PB ratio of 0.71x, dividend yield of 2.3%, and a beta of 1.25. It is a universal bank with investment banking upside. HSBC, PE ratio of 10.10x, PB ratio of 1.35x, and a dividend yield of 5.0%. It features global scale and a high return on capital. Standard Chartered, PE ratio of 11.50x, PB ratio of 1.04x, and a dividend yield of 2.2%. It has an emerging markets focus. NatWest trades at a 38% PE discount to Lloyds despite having a similar domestic business model and superior current profitability metrics, 19.2% ROTE, versus Lloyds' lower expected growth. This valuation disconnect is a central pillar for those who believe NatWest is the best value in the sector. However, the bear case would point to Barclays' 0.71x PB ratio as a sign that the entire UK banking sector is being derated due to the country's fiscal position and political instability. Mortgage market sensitivity and the refinancing cliff. The UK mortgage market is the primary battleground for NatWest's asset quality. With a £215 billion book, any shift in house prices or interest rate expectations has an outsized impact on the bank's risk-weighted assets. In early 2026, NatWest took a more aggressive stance, lending £10 billion to first-time buyers and adjusting its criteria to allow 6 times income multiples for high earners. While this expansion of criteria supports lending volumes, it increases sensitivity to the Iran war interest rate shock. If mortgage rates, which were trending downward in early 2025, resume an upward trajectory due to oil-driven inflation, the demand for these new high-multiple loans will evaporate. Furthermore, the average first-time buyer deposit has fallen by 14% year-over-year across the industry, suggesting that the equity cushion for new loans is thinner than in previous cycles. The bull case focuses on the 57% LTV, which implies that even a 20% correction in UK house prices would leave the vast majority of the bank's customers with positive equity. The bear case focuses on the 0.4% arrears, noting that this is a lagging indicator and that the real stress from the 2025-2026 rate hikes has yet to be fully reflected in the delinquency data. Conclusion. The analysis of NatWest Group plc reveals a fundamental tension between institutional strength and environmental decay. The bank has transformed its internal architecture, creating a high ROE engine that is supported by a massive structural hedge. For the bull investor, the 9.15x PE ratio and the 5.5% dividend yield represent an opportunistic entry point into a high-quality asset that is being unfairly penalized for its UK domicile. The hidden value in the structural hedge reinvestment and the potential for a wealth management re-rating provide clear catalysts for share price appreciation. However, the bear case cannot be ignored. The 2026 Iran war shock has fundamentally changed the risk profile of domestic UK banks. If the OBR's downgraded growth forecasts and rising unemployment predictions prove accurate, the credit cycle will eventually turn, and the benign impairment environment of 2025 will become a memory. The threat of higher for longer inflation forcing the Bank of England to maintain restrictive rates in a weak economy creates a stagflationary backdrop that has historically been the worst environment for banking stocks.